Hi everyone, I am Mathieu Favas, the Economist Finance correspondent covering banking, insurance and asset management, among a few other investment topics. It's a pleasure to be chairing this event on the role impact investing can play in making the planet greener, fairer and more inclusive. I'd like to thank HSBC Private Banking for supporting the event and making it possible. And I'd like to thank all the speakers today and the audience for joining us. First, we're going to be hearing from Johan Elias in a fireside chat about sustainable philanthropy, before being joined by a panel to discuss building back better in impact investing. As the world economy seeks to recover and rebuild after the current crisis, what role does impact investing have in ensuring inclusive growth? How can impact investors help tackle the world's most pressing issues through their investments? These are a few of the topics we'll cover today. I'd like to mention that we are taking questions through this session, so feel free to send them to us using the Q&A function. Ask anything you want, and I'll do my very best to get them to our panelists, either during the session or at the end of it. Just to set the scene a bit on what we're going to discuss today, I'll just mention that after many years of rising significance, impact investing has now reached the mainstream. As long-term investors become aware of their responsibility to society, and as environmental issues increase in importance, the impact investing community has continued to grow as well. Yet there are concerns that the term has become too broad, a bit overused, and as ever more investors try and stake their claim, there is a sense that investors want to get back to the genuine concept itself. And now the community faces an unprecedented challenge, the coronavirus pandemic. Millions of people in communities worldwide have been plunged into hardship, whole economies have shut down, and the environment has too often been brushed aside as a secondary concern. However, this presents a unique opportunity for those with the broadest shoulders to shape a new world, to invest in bringing about a better reality in the post-pandemic world. So how can investors ensure that sustainability is front of mind as economies seek to rebuild in the months ahead? What are the tools available to wealthy investors who would consider environmental and social good as part of their remit? And how can the investing community ensure that the coronavirus response doesn't overshadow all these pressing issues? To discuss these themes, we are going to kick off with a fireside chat with Johan Elias. And I won't spend too much time detailing his CV, as it is very long and full of impressive roles and achievements. But I will say that Johan has a knack at spotting trends long before they become fashionable. And that is true of his efforts to help protect the environment, and most notably rainforest, including through Cool Earth, the charity he co-founded in 2007. Johan, welcome to our session today, and thank you for joining us.
Thank you.
It's a pleasure to have you. Could we start perhaps by talking about business? Tell us a bit about your career and businesses that you have turned around and built, of which there were several, including the Sportswear Group head, which you now run.
Yeah, so my background is in restructuring and turnarounds of companies. So the one company that I'm most famous for is Head, which is a global manufacturer and marketeer of sporting goods equipment.
Can you give us perhaps a bit of context how you came to lead the company, and perhaps some of the ventures that you helped turn around when they were facing difficulties?
Well, so with Head, that's a company that I bought in 1995. It was hugely loss-making, and I managed to turn it around to become very profitable. Also made some acquisitions, bolt-on acquisitions along the way to help stimulate growth and expand product categories, etc., which is fairly typical for a turnaround phase two, once you've turned it into profit.
Right, okay. And so at what stage of your successful career did you first begin to use your influence and wealth for good? What options did you consider then also to exert the most impacts?
So I always took an interest in I would say, areas of concern So the environment, rainforests, something that I've always taken a great interest in. And when I looked at the environment and climate change, I quickly came to the conclusion that not only was the rainforest the lowest hanging fruit, but the area where we can have the biggest impact short term for the benefit of the long term. Which, if you look at all the targets that we've set out, if we want to be net zero, the only way we can be truly net zero is if we address biodiversity and forestry. I hope that with time, with the right focus on R&D and innovation, that we'll find ways of decarbonize our economy. But that will also require a lot of investing and time to get there. But in the meantime, we can have a significant impact on our carbon footprint globally through reforestation and also, of course, avoided deforestation. So that is why, and that was a theme which was already existent 15, 20 years ago, when I started taking, shall we say, a focused interest on avoided deforestation. And that's the reason I got heavily involved.
And so, for other would-be philanthropists who might be considering their wealth to achieve similar aims, to use it for good, what sort of advice would you give them when they might be seeking to build their giving portfolios or their plan of action in philanthropy?
Well, philanthropy, it's not as simple as you just give money away. But you need to figure out and do your homework on where you can have a good impact for the better good of what you're trying to achieve. So you need to be quite methodical in your approach. So if you want to go through an existing organization, you need to do your research to make sure that the money is well spent, that they have an organization which is capable of executing and delivering on the objectives. And that's in fact how Howarth came into being. And that was Frank Field, who was then an MP. He called me up actually out of the blue and said, Johan, I think saving the rainforests is so important to mankind. How can we make this possible for just anybody? You don't have to buy a rainforest. So we came up with the concept of enabling areas that were exposed to deforestation to basically make the standing tree more valuable than the cut down tree, which is the basics of rainforest economics. And the one thing that we focused very hard on was to find a setup where we spent as little money as possible on the administration of the organization without jeopardizing the goals of having flawless execution in what we did. And that worked really well. We combined, say, the talents of great people used to working with charitable organizations, with business skills to keep costs as low as possible, working with KPIs to make sure that we really deliver. And that is key. So back to your question here. If you want to do something and you want to make a difference, pick a subject matter which you're passionate about, because you're more likely to achieve things if you're passionate about something. And then make sure that what you do is sustainable, that it is not something which consumes money, which doesn't have a life. It's very important that what you do has permanent impact.
You mentioned KPIs, and of course you're a businessman, so you expect results. In philanthropy, how do you measure performance, and how do you assess success? Perhaps you can tell us a bit more about the KPIs, for example, in your case at the organization, and perhaps a few other examples that you might be aware of.
So in my work with rainforests, the objective was always twofold, actually. Number one, to ensure that the people living in the rainforest had the opportunities to livelihoods and lives that were sustainable, and at the same time you could reduce the deforestation rates down to zero. And when I say sustainable, so the type of things you do is you help with educational projects, healthcare projects. You have to create economic opportunities. So in my rainforested areas, what I do is I give the harvesting rights to things like fruits and nuts to the local indigenous population. So they can go in on the property, pick as much as they want, and keep all the proceeds from selling the nuts and the fruits. And when you do that, you incentivize the people living in the rainforest to protect the rainforest for their own good. So that's a good example of KPIs that work. And I'm happy to say that this approach has now been, I think, globally adopted and is part of the UN protocols for how to preserve the rainforest.
Mm-hmm. Yes, I was going to ask you actually about this. So, because I know you have strong views on politics and foreign affairs, and saving the environment requires global cooperation. Are you confident that this can be achieved? How optimistic are you that we will see that in the coming years?
And I think a lot will depend on the elections in the US tomorrow, in terms of the speed at which we can make a difference. And of course, global coordination here is paramount. And the one thing which we perhaps lack today is a global organization which is like, call it a World Climate Change Agency, a carbon bank, a central bank for carbon footprint, which has the combined resources of what sits today in the UN, the World Bank, and many other organizations. I think the more we pool resources, the easier the process will be.
Yes. And then I'd like to end perhaps with a question on your next priorities, because you're always working on the next project. What are they, both inside Howarth and perhaps outside it? What are you working on at the moment?
Well, I'd say we're working on keep doing what we're doing. There's always room for improvement. I just up the standards and keep doing it. I don't think for climate change there is a magic wand. It is it's hard work, and will require focus and dedication, not only by the politicians, but significantly by private individuals, corporations, all stakeholders in society have to come together to achieve this.
Yes, and I guess impact investing also can and will play a role in that endeavor. Thank you very much, Johan, for taking part today, and we wish you all the best.
Thank you, Matthew.
Let us now turn to our panel on impact investing, during which we'll assess the extent to which this extraordinary year has provided us with an opportunity to deploy funding and finance to build a more inclusive and sustainable economy. I would like to mention again that we are taking questions through this session, so feel free to use the Q&A function to ask anything, and I'll direct your questions to the panelists. And if you've joined us en route, I am Matthew Favas, the Economist Finance correspondent. And to set the scene, let me highlight perhaps the dilemma or the conundrum that impact investing finds itself in. So on the one hand, doing well by doing good has risen to prominence in recent years. Investors have introduced this in their investment plans. It's become a strategy followed by many blue chip firms. On the other hand, the scale of the COVID-induced economic shock and its dramatic effect on our livelihoods threaten to make some of the concerns that it is typically addressing perhaps more secondary or make them re-seen in the background. Or perhaps it is an opportunity. This is one of the topics we'll address today in this panel. I'd like to thank you all for joining us, and I'm pleased to introduce you to a very strong panel of experts to guide us through these thorny questions. First, we'll have Zoë Knight, who is the Managing Director and the Group Head of HSBC Center of Sustainable Finance. We have Jane Ambachtsheer, Global Head of Sustainability at BNP Paribas Asset Management. Simm, who is the Founder and Chief Executive Officer of Impax Asset Management. And Howarth, the Chief Executive Officer of ShareAction. Our speakers' bios are available on the website, by the way, so if you'd like to learn a bit more about their careers and roles, feel free to have a little browse. Welcome to all, and thank you very much for joining us. Let's get started perhaps with a few definitions. So I've been covering investment for a number of years now, and both in the public and private sphere. And many asset managers would argue that their investments are always impactful. They will say that they support the economy, they help small and medium-sized businesses, they create jobs. So when we are talking about impact investing, what exactly are we talking about? How does impact investing differ from investing proper? So maybe, Zoë, you could start on this, since you have been advising investors for decades on such issues.
Well, thank you, Matthew, and to The Economist for the invitation to participate in this session. And also, I'd really like to acknowledge that my fellow panelists have been covering this space for so long as well. So I'm delighted to be joining them and see their faces, even if it's only on screen this morning rather than in the room. But first off, you're right, impact investing, sustainable finance, ESG, thematics, all of these terms have been bandied around for a long time and have evolved into where we are today. And so for us at HSBC, impact investing is about providing a positive outcome in relation to certain factors, whether that's saving CO2 to help solve climate problems, whether it's helping on the social aspect of helping with development goals, whether that's education or health, and also thinking about the governance issues of the investments that we make. So in terms of how impact has evolved, we all know that the investor community started out with some very defined thematic approaches around how to think about environmental, social and governance issues, and that's a broad spectrum. So I'll stop there for now because I think we're going to get into a debate about this, and I'm sure everybody's got their different perspective of what they want to bring.
Thanks, Zoë. I'd like to ask this question to Jane as well, because of course you're deeply involved in the issue.
Certainly. So, I mean, we have a kind of a formal definition for impact investing, and we're quite strict, I think, in terms of the funds that we'll actually apply that label to. So you have to meet two specific criteria. You have to have intentionality, so an articulated intention to generate positive impact, which you then commit to measure and report. So there are a lot of funds that might be associated with a number of sustainable development goals. For example, you tend to see more and more marketing materials from a number of organizations that plaster the sustainable development goals on things, which are, beautiful and lovely and very motivating. But unless you can really articulate which specific KPIs an investment will contribute to and how you're going to measure that and report on that, it's not technically an impact investment from our perspective. And I think that's broadly accepted in the industry, although there's still quite a lot of kind of fuzziness, I think, in some cases. So that's how we would, technically define impact investing. So our range of funds is quite small because we have that hurdle that you need to pass for us to be able to, kind of apply that impact kind of label. But I think it's equally important, if not more important, to really acknowledge that all of our investments have impact, as you noted. And I think what's really interesting is to think about, I think, a growth in the industry of large asset managers, in particular, who have been maybe a little bit late to the party in terms of thinking about sustainable investing, starting to acknowledge the impact that all of our investment have. And, the fundamental economic urgency of achieving the Sustainable Development Goals and the Paris Agreement, and understanding that all of our investments are impacting that in a positive or a negative way. And we really need to own that, and we need to kind of try to understand that and try to make sure that we're aligning those investments and our engagement activity towards a more positive kind of economic future. So we're looking both at the kind of niche impact investing subject and range of funds, but broadly trying to embrace our impact as an investor, from a wider economic sense.
Turning to you, Jan, of course, you've got a pretty targeted approach and you've been at it for also quite a few years. So you must have seen the impact investing concept evolve over time. Is it your sense that it's perhaps become too broad, that it encompasses too many objectives?
Well, I think it is a pretty tricky term, and it's definitely worth going back to first principles to try and sort of unpack what's going on here. If you think about how most of the money in the world is managed, it goes through three steps. The group, be it a pension fund or a private bank or an insurance company, establishes its investment beliefs. And within the framework of its investment beliefs, it then looks for opportunities and then it manages risks. So in that context, impact investing can be one of two things. It can either be directional or it can be concessional. What I mean by directional is that within the framework of investment beliefs, opportunities and risks, it's perfectly possible to tilt your portfolios towards those industries that are having a positive impact on society, for example, renewable energy, clean transportation, recycling, etc., and still aspire to market level or market beating returns. That's, if you like, the thematic approach. It's directional. The concessional bucket is obviously more akin to philanthropy, where the investor maybe has investment beliefs that allow them to stray away from market level returns, maybe take a bit more risk, and provide some money to areas of the economy or even charity where there's definitely much more manageable, positive environmental social outcomes, impact, if you like, potentially some financial return, not necessarily in line with the market.
And I'll get to you, Catherine, very shortly, because I'm really interested to hear your views. Just a quick follow-up for Jan. Is it your sense that investors understand the distinction between these two strands of impact investing?
I think professional investors, those that run these large institutions, do understand the strands, but I do think there's a lot of confusion in the marketplace. And I think we would help this debate enormously if we called out what these differences are. So impact investing is not properly defined. There's no scientific sort of basis of the term. But if we recognise that there's two different types of it and triage conversations into one or the other, I think we'll make quite a lot of progress. So
turning to you, Catherine, so you've heard what our panelists had to say on impact investing, the way they define it. Your role, of course, at ShareAction is, and also within the task force on asset management that you have with the Treasury, is to make sure this intent is turned into action. So what do you make of this definition? Are they too broad? Are they too narrow? If the goal is to make things happen. Is that satisfactory?
Well, I'm very happy with the definition that Jane laid out and that they apply at BNP Paribas, that so-called labeled impact investing funds have to really commit to a clear and defined intention to deliver positive impacts of some sort, and also then to measure and report the difference. But I also really want to pick up on the point she made, that all investments create impacts in the world, and a very large number of investments for many years have created lots of negative impacts in the world. Whether it's in the agricultural sector or in the retail sector or in fashion or in mining or in the energy sector, our investments through our pension funds and through our high net worth portfolios are having a huge blend of impacts. And most of the investment industry has not yet got any kind of coherent methodology to really capture the impacts generated by the vast bulk of capital markets investments across the world. And the impact investing, specialty is actually a relatively niche, albeit absolutely pioneering, part of the global total capital markets. And what we're interested in at ShareAction, and the kind of work I've been doing with that Treasury Task Force, is to try and ensure that the power of the mainstream capital markets is deployed in a more intentional and aware way, so that collectively we can dial up the positive and dial down the negative impacts of our investments. And let's face it, the biggest companies in the world are the ones that have the biggest impacts, for good and ill. So just thinking very topically, that in the last 24 hours, we've had this world-changing announcement from Pfizer that they've just developed a vaccine. And, they're talking about 1.5 billion doses of that vaccine in the next, 18 months or so, and there'll be other companies coming up the track. That's going to have an enormous impact on people's lives, on our economy. And at the same time, the pharmaceutical industry is far from perfect. Pfizer itself is one of the companies that, along with GSK, produces vaccines for pneumonia, including pneumonia in children. Pneumonia is the biggest killer of children under 5 in the world, and there are millions of children who don't get access to pneumonia vaccines. So, an impact investing lens on that would be, fantastic share price growth of 20% since just yesterday for Pfizer. Amazing positive impact with that vaccine. But let's see that company also step up and do more to enable the world's children, to get the vaccinations they need for pneumonia. So I'm just trying to kind of widen the debate and acknowledge that this wonderful movement for impact investing has much, much further to travel. And actually, I think we should widen our ambition and strengthen our ambition and look to see every investment accountable for its impacts, measuring that, finding convincing, robust methodologies, and we're still a long way from that. And also acknowledging, in the pension fund space, for example, that every pension saver has an interest in avoiding catastrophic climate change, for example. So we really do need to ensure that, these mainstream pension fund investors are really thinking about avoiding those negative impacts. That really does become part of their fiduciary duty in quite a kind of mainstream way. And so that's the revolution I want to see, that we take the pioneering thinking in the impact investing kind of niche and we widen it out and bring it to bear in a way that really transforms our world.
Thanks very much, Catherine. That's a very laudable ambition, and I hope we can lay some of the steps today in the discussion. Let's spend a bit of time on measurement and reporting, because that's of course a crucial question when it comes to impact investing. I think Zoë, you wanted to react on this.
Yeah, I mean, all of us have referred to the measurement and reporting point because it is so important. And just as Catherine pointed out, we have made so much progress in specific types of impact which are very well defined, i.e. we know as investors very clearly what green activities look like, and we know very clearly how to measure CO2 related to those activities. What we're not so good at is measuring the impact where those activities might not necessarily be clear in terms of the benefit that they bring to, for example, solving the climate problem. And what I'm talking about here is issues like industry. So we know that it's very straightforward thinking to want to scale up renewable power to help with the climate problem. But in the industrial backdrop, where, for example, it might not be clear what that decarbonisation roadmap looks like, we need to be much more fast-paced at thinking about how to measure and report on that journey towards a net zero outcome that we're all striving for in terms of climate, but also in relation to those social factors as well. So I think this measurement and reporting point is going to come through again and again and again in terms of providing credibility to the asset management community and to the investor perspective of how to demonstrate that where you're putting your money essentially really is having true impact, and how to avoid concerns about greenwash or concerns about the point that actually how you're investing is really not giving you the impacts that you're hoping for.
Could I ask about your experience, Jane, with these questions? Because obviously, across your investment products, this is something you've had to grapple with. Is that something that you've learned whilst practicing? Is that something that investors have helped you with? What has been your general path of learning with the metrics?
Absolutely. I mean, look, this is an ongoing conversation and something that we're working on kind of every day. So for some of the funds that are currently in our impact range, that would include our social business fund. So we do direct impact investments in France, primarily in unlisted social enterprises. So that's relatively straightforward. We can count the number of new jobs created. We can count the number of individuals that have had different kinds of training. We can count the number of new beds that have been created in care homes. So that's relatively straightforward. If you look at our green bond fund, we look at things like reduced emissions, but we also have a temperature metric. And this is an area where we're seeing a huge amount of interest in the market. So our green bond fund, for example, is aligned with a 2-degree pathway, where the reference portfolio is on a 3.2-degree pathway. So that's something that is a really interesting metric because it's easy for people to understand. And, if you think back a couple of years when the IPCC issued their big report on really the difference between 1.5 degrees and 2 degrees, I think that was really a turning point in the industry where people shifted away from thinking about the carbon budget and how that needs to kind of be managed and reduced towards net zero, and really a focus on net zero by 2050 and science-based targets and those commitments in that pathway. And I think that's really shifted thinking and made a temperature pathway much more kind of desirable and interesting. However, we recognize that there are lots of different methodologies out there. The French government recently commissioned a report looking at 12 different methodologies, compared the temperature associated with the same portfolio, and had 12 different outcomes essentially. So we know there's more work to be done in this area. It's not perfect, but it certainly is a great indicator and something that's easy for individuals to understand. So from the TCFD, in fact, so the Task Force on Climate-Related Financial Disclosures, which I'm a member of, we recently issued an update report and issued a consultation on forward-looking metrics to really try to dig into this more deeply. And one of the key metrics that we're asking for feedback on is temperature alignment, because it's such a kind of great and easy to understand indicator, while we recognize more work needs to be done around methodology. And it's not something I think that, the asset management industry should be competing around. It's something we should be collaborating on to find, the best common metrics so that we can have consistency, measurability. It should be science-led and evidence-led. So I think, sorry, long answer to a short question, but the relevant indicators really vary depending on the strategy. Our philosophy is that they should be measurable, they should be simple, they should be consistent. And we're also interested in looking to have them, as much as it makes sense, align across our range of different funds, so that we also can think about our positive impact from a firm-wide perspective. So that's another kind of project that we're working on.
Jan, of course, your strategy is more focused, but equally, I was curious to hear whether your investors, by which I mean the asset owners, your clients, are they very much in demand of such metrics, such measures, especially when it comes to carbon reduction?
Yeah, so we first started investing in environmental technologies and businesses improving the environment back in 1998. So we've got more than 20 years of experience of doing that, both in listed companies and private companies. In the early years, impact investing was really about private investments, venture capital. But in 2014, we started gathering data from the listed companies we invest in around their environmental impacts. And generally speaking, they all had positive environmental impact, for example, water conservation or recycling or net CO2 being positive. I think there are a number of learning points starting in 2014. So we've been doing this now for 6 years and producing an annual impact report. I think the first one is just the range of complexity. So as Zoe and Jane have said, measuring jobs is easy. Measuring carbon footprint sounds easy, but it's actually a little bit tricky, and there are different methodologies. Measuring water conservation is incredibly hard because you need a baseline, you need a reference point. It's very location specific. So first point of learning is just the sort of the range of complexity. I think the second point of learning is it's really quite difficult gathering this data in a consistent fashion so that you can aggregate the data across their portfolio. So we've spent literally 6 years in dialogue with the management teams of the 200 or so companies that we invest in, trying to extract data from them in a consistent fashion so we can actually compare across the portfolio and come up with sort of weighted averages. And the third learning point, I think, is just trade-offs. And I think this is a crucial point about impact investing. It does sound superficially very attractive to invest in renewable energy, but if you put up wind farms on land, then you are creating visual impact, which a number of communities locally may object. It does have an impact on local infrastructure. You need to put in new roads, which can affect wildlife and habitats. If you invest in water systems, you're extracting water to provide it, but then you're also providing sewage treatments and sludge treatment services, which produce hazardous waste. So we do need to be very thoughtful about how we're looking at impact metrics and recognize that there are trade-offs here.
Thanks, Jan. And just to pick up on two of your points and turning to Catherine now. First on the data collection issues, I was curious to hear your views, Catherine, on where you think the main gaps are. And secondly, the trade-offs. So very interesting example that Jan provided. How do you think investors and companies should deal with such trade-offs? What is the right framework of thinking to find the right thing to do?
Well, let me just start with an area where I think there are lots of huge gaps in the data required for investors to really rigorously evaluate their impact and look to improve it in a consistent way. So one of them is in the area of kind of workforce data. So just as every company makes some kind of an environmental footprint, every company by definition is an employer of some sort. And for many companies, most of their employment is actually in supply chains. Increasingly, large listed companies actually have a rather small workforce, but they can have a ginormous supply chain around the world. And whilst most companies will say, our people are our greatest asset, in fact, there's very weak data available, which allows investors to compare how companies manage human capital, so-called, how they manage the workforce. But both from a financial risk point of view and from an impact point of view, this is an enormously important question where currently the data is really weak. Now, it's one project where at ShareAction we've tried to help fill the gap with something called the Workforce Disclosure Initiative, which is trying to do for workforce data what CDP has done in a very pioneering way on environmental metrics and reporting and data from companies over the last 15 years. But it's just one example of how, if we're going to get serious about impact and we're going to get serious about mainstreaming impact, which I think is fundamentally needed and very, very exciting as a vision, we also need to get absolutely serious about these data questions. Now, coming on to the issue of trade-offs, which Ian raised, I mean, investors are used to making trade-offs all of the time. It's part of what, the skill set fundamentally of an investor is. But of course, the more information you've got, the more intelligently you can assess those trade-offs. And the more information you have about companies' environmental and social footprints and impacts, the more you can assess, financial versus social, environmental materiality and impact. And you can kind of weigh all these things up. And the more you can then actually give your true investors, the people that are maybe your customers as an investment manager, a real picture of what's going on. I mean, Jane talked to several people have raised the thorny issue of greenwashing and impact washing. And, there's huge popular demand, both whether it's from high net worth individuals or much more ordinary, working people with retirement savings, in investing in a way that delivers positive change in the world. And so there's a proliferation right now of investment funds that are making claims in this space. And some of that is not really worth the paper it's written on. But until we have comparable and agreed methodologies, and I entirely agree with Jane that actually the industry needs to come together and commit around agreed standards. And we're beginning to see a really strong movement in support of that at a global level in terms of corporate sustainability reporting, which is very exciting and a key part of the infrastructure. But until we get that, there's a huge risk out there that customers and retail clients of the investment industry are being sold something that sounds good and is a lot less authentic.
And what do you think is the main risk if we don't go fast enough? Could it be that there is a bit of cynicism that starts to emerge? Catherine.
Yeah, I think there's the risk of cynicism, but more importantly, there's the risk. There's a risk that there is a risk of cynicism, but more importantly, there's a risk that the investment management industry, fails to deliver on its real social purpose in society. It is to build wealth, but I think it's to build wealth in a way that builds resilience and sustainability as well. And more that's becoming recognized as necessary, and particularly as a result of the COVID pandemic. We realize how vulnerable and fragile all of us are. And I was just involved in a different event with the OECD yesterday, and some very scary numbers about what's happening in the poorest countries in the world as a result of the pandemic, the withdrawal of aid just at a time when those countries really need support. And actually, the impact investing story is one that could really, make a difference. And it's not just altruistic. It's absolutely collectively, at a species level, in our interest that we, achieve good human development and environmental safeguards at this time. So I think we need to kind of stop thinking about impact investing as a kind of niche add-on luxury and start to think of it as a societal necessity, and then charge our investment industry with helping us to deliver that, because it really does see an incredibly important social role and purpose for the investment industry. But it needs rigor, it needs scrutiny from the outside, from organizations like mine, but also from financial regulators. And I'm very actually impressed by how financial regulators are starting to look at making sure that the marketing of products is robust and that customers cannot be sold an impact product that actually doesn't deliver impact. So I'm hopeful about the regulatory oversight, which is much needed in order to avoid the types of problems we've all been describing.
Jane, your extensive suite of funds is testimony to the appetite that investors have for impact investing. So it's starting to get out of the niche that Catherine was was describing. What, in your view, are the main factors that explain that are feeding this appetite for impact?
Well, I think, Catherine touched on some of the key challenges we're facing right now. And I think it's between the climate crisis, very, very sobering new research about species loss, biodiversity, an urgent need to address that, as well as the kind of triple, health, economic, and social impacts of COVID, I think has really created, this kind of multiple crisis at the same time, an opening for evolving our economic model and really kind of building back better in the context of green, inclusive, et cetera. So I think that it's really created a lot of concern, but at the same time, never let a good crisis go to waste. And so I think that a lot of people have really kind of focused on that opportunity. And of course, it's helped that we've seen that sustainable funds more broadly have performed quite well through the crisis in a relative context. So we have about 15% of our assets, which we label as sustainable plus. Now, those are not all impact funds, because I mentioned to be impact, you have to really meet quite a high threshold. But we applied our sustainable investing across all of our different investment strategies. So ESG integration, stewardship, voting, engagement, our different exclusion policies, and our focus on the future. So we have three kind of strategic themes that we actually in 2019 identified as really being the kind of critical preconditions for a sustainable economic future, 3 E's. So the energy transition, achieving the Paris Agreement, environmental sustainability, and equality and inclusive growth. And so actually those 3 themes have really been incredibly present through 2020. So we've been quite well positioned in terms of, we organize our different sustainable themes, our sustainable funds under those 3 themes. But it also drives a lot of our strategic research, our shareholder engagement campaigns. We've been addressing corporate lobbying on climate, many different topics. So that 15% of our AUM that we deem to be sustainable plus has grown more quickly than the rest of our kind of different assets. Even though they're also sustainable, our sustainable plus funds go further. They may have a label, they may be an SRI fund, things like our green bond fund. That different range that does even more has been really attracting a number of new clients. And so we continue to kind of innovate in that area, and we expect to see continued growth within that specific area. And I'll just give one example, building on what Catherine was talking about in terms of really looking at employee welfare, human capital management as a key theme. We're working on a new fund called the Inclusive Growth Fund. So for this, we've actually built a new kind of ESG model to measure company performance through an inclusive growth lens. So what does that mean? So we look at things like, how employees are, employee engagement, levels of employee engagement. We look at pay, so pay gaps between senior executives and kind of, average workers or median workers. We look at issues like tax payments and tax transparency across the organization, as well as overall kind of reporting and engagement. So that helps us to narrow the universe of companies that we think are doing a good job in the context of an inclusive growth model that really focuses on stakeholder management and has proven to be more resilient through this crisis that we've seen this year. Now, when we launch that fund later this year, it won't be an impact investing fund, because we're not measuring the specific products or services necessarily that those companies are creating in terms of how many new hospital beds are being created or how many avoided emissions are we having. We're measuring the behavior of the companies in terms of employment practices, job sustainability, tax payments, et cetera. So it's one of those examples where we're kind of looking at how company behavior on a day-to-day basis through their direct employees, through their supply chain. Of course it has an impact. Of course it's increasingly under scrutiny by civil society, by their consumers, but it's not necessarily impact investing, right? So it's kind of coming back to that original dilemma that we opened with.
Yes, that echoes some of the points that Zoe made earlier, and I was going to turn to you, Zoe, perhaps to zoom in on the role or the impact of COVID-19 on investors' appetite for impact investing, because there is a tension of it, right? In the sense that it makes some of the issues even more urgent, but at the same time, because of the severity of the crisis, it threatens to put some of them on the back burner a bit, at least in the politicians' minds or investors' priorities. What do you think is likely to ensue there?
Yeah. Well, I think it was Morningstar that reported that some 21 billion of inflows had come into the ESG space in the first half of this year. So appetite for ESG and impact is certainly not waning in response to the COVID crisis, which of course is what you would expect. You would expect this pivot towards thinking around more social aspects. And indeed, the green bond space and the social and sustainability linked bond space has grown in prominence over the last few years. But again, this year in particular, over 50% of issuance has pivoted towards that social element. So, to build on Jane's point about not letting a good crisis go to waste, I think we are starting to see the signs of people pivoting to think about these issues more significantly. But that said, we're not moving quickly enough, and we do need to do more. The other point around collaborating across the industry as a whole is a really important one, because we need to pick up the pace of finding, so the asset management industry and the investor community is doing a really, really good job of engaging with corporates, of joining coalitions around more effective standardization of reporting through initiatives like the TCFD. But they need, and we need, client demand for those products and services, and we need to get better at bringing people along with us to stoke that activity across the asset management industry as a whole. And we know that we are facing severe risks in relation to biodiversity and climate. And these joint coalitions across different players, whether it's more of the multilateral development banks plus private asset managements coming together to work on products in the way that we have at HSBC with the World Bank to launch the Regio product, which is the real economy green investment opportunity space. They're all a necessity to take that thinking forward and to accelerate the scale of investment required to address these challenges. The last thing I would say on appetite, which I'm interested to hear whether the other panelists are seeing this as well, is there's been a massive uptick in thinking around a net zero concept in terms of, clearly we need to reduce emissions as much as we can out of the system, but there is a sense that given those negative impacts that Catherine talked about earlier of destruction and environmental loss, we need to really focus a little bit more on building up that resilience side and that ecosystem services and nature-based solution side of the equation. So thinking about appetite and what investors might be looking for next, that expansion into nature and ecosystems, I suspect, will become much more prominent as we move into the next sort of 12, 18, 24 months going forward.
Jan, could we perhaps ask you for some concrete examples or an illustration of what an investor base looks like in impact investing? So you've been in this space for a long time, as we said. Have you seen your investor base change dramatically over the last few years? In terms of composition, in terms of geography, what has been the shift, if there is any, that you've seen?
Yeah, so right from the outset in 1998, Impax has been focused on directional investing. That's the thematic approach to particularly environmental improvement, but latterly also social improvement, particularly around backing companies with strong female leadership. So in the early years, we appealed to pension funds and private banks who had clients with investment beliefs that really were keen to stay in line with the market or beat the market, but were very focused on wanting to have environmental benefits as well. So we've never really been in the concessional part of impact investing. I would say that core group of, if you like, commercial, fiduciary driven institutional investors looking for a directional tilt has grown enormously in the last 5 years. So up until the Paris Climate Agreement in 2015, it was a relatively small group, particularly European and coastal American investors, Canadian investors, and some in Australia, but not growing very rapidly. And I think after the Paris Climate Agreement, it really exploded. So today we still have that core group. I would say it's probably about half of our asset base. We're managing about $27 billion now, so about half of that. And the other half really is mainstream investors who are just looking at the next decade and wondering where growth is going to come from. And I think this is one of the points I wanted to build on in the context of Catherine's comments a moment ago. I think government has a crucial role to support impact investing or those who are interested in positive impact. If we think about the enormous benefit for directions in markets around the net zero commitments in a growing number of countries, if we think about the crucial role that the commitment or the government mandate to phase out internal combustion engine and even hybrid cars by the 2030s has on the automotive sector, think about the role that government has to play in shaping water markets and shaping waste management markets. As impact investors or those with clients who are interested in this space, it's absolutely crucial. We need to recognise that government does three things. First of all, it sort of regulates and monitors what we say around impact metrics to make sure they're correct. Secondly, in the context of TCFD and the new Task Force on Nature-related Financial Disclosures that Impax is involved with, there is a requirement from government to disclose risk. But crucially, and I think this is probably the most important thing which we are at risk of overlooking, governments do shape markets. And as investors looking for impact, I think we can consciously sit down with policymakers and help them to design investment grade policies to transform some of these industries. That's, I think, where we're going to have as much impact as anywhere else. Impact is definitely working quite intensively on that. We've got 4 or 5 colleagues who are working hard, if not full-time, on discussing market development with regulators.
Another very important stakeholder, of course, is the public, right? Is the consumers. And we have actually a really good question from the audience here, which I'll probably ask Catherine. What role do you think the public has in making all this happen, actually, in putting some pressure on investors, on the companies? I think you might be on mute, Catherine.
Thank you. Such an important role for the retail investor, for the individual investor, for the family. You know, anyone with any kind of assets that are invested by other professionals in the market and savings and family wealth can have such a positive impact on this whole development of this story. So it's really critical that you ask your financial advisors about the impact of your investment strategies. You ask to have investment strategies that are impact driven, but don't ignore, you know, that small niche of impact, very sort of pure, tightly defined impact investments, critical as they are in terms of paving the way. The risk, I think, is that people think, well, I've done that, and then they don't need to worry about, you know, the 90 or 95% of their wealth that's actually invested in more mainstream products, because where we really generate impact is by sort of shifting the thinking in a more impactful direction in the rest of the broader mainstream capital markets, and it is happening, which is wonderful. And one of the reasons it's happening is that there is pressure from clients, and there's more and more evidence that that's what people want. So, you know, there's the start of pension funds surveying their members about their views and preferences in terms of impact investing, and finding huge support, which gives the trustees of those pension funds a mandate to invest in a more impactful way, to have policies that really think about tracking and dialing up impact. So yeah, I'm very encouraged by the broad popular support. And I think, to go back to Ian's point on kind of regulatory policy and public policy in this area, I think it's very important that more is done to set regulations which require professional investors to ask their clients about their impact preferences, and then for those to be reflected in the design of investment strategies to suit them. So there could be a lot of regulatory reform to help express and sort of drive into the investment industry this very strong underlying grassroots kind of popular sentiment in the population in support of this style of investing.
A couple more questions from the audience, both really good, which I'll group into one. Good, but tricky potentially. The audience mentioned two themes that we have not actually covered all that much yet in the conversation. One is racial justice. The other one is poverty extinction or eradication. Do you feel they should be part of the conversation, or at least more of a part of the conversation? And if so, how to make that happen? Could I ask Zoë, perhaps, this question?
Yeah, for sure. So clearly, the whole impact spectrum has a wide range of issues, all equally as important as each other, but that ebb and flow in terms of their prominence to wider society and what broader consumers are thinking about. But the thing that I would say is that the asset management community generally is working on all of these issues behind the scenes all of the time. So it may well be that they are actively supporting a milestone moment around climate when it is relevant to do that. They may well be supporting a moment around another issue when it becomes prominent to showcase what they're already doing in that space and tell society more broadly, or give society more details about what they're doing. So I think that there's this underlying groundswell among those institutional investors and those high net worth clients that are thinking about these issues all of the time. What we will see going forward, and this goes back a little bit towards the monitoring and reporting piece, is greater transparency around how each of those categories are being thought about within the various organizations. So, of course, the racial justice element is very much captured within diversity and inclusion, and as Jane alluded to, many firms are already thinking about this and are positioning thinking within their approach to investment selection and to deciding on which companies they will overweight in the portfolio versus those that they think might not do as well in the future because of poor practices around the way that they treat employees or the way that they treat civil society as large. I mean, the critical component of this is the progress within the Sustainable Development Goals generally, and how we can think about accelerating impact through those factors. But I would like to try and get that sense across that there is this groundswell underpinning everything that those within the asset management space are thinking about when it comes to incorporating environmental, social, and governance decision-making.
If I can just jump in with a comment.
Yep.
I think, we haven't really talked so much about the U.S. election results, which of course, were a huge kind of fork in the road moment for our entire sector. But I think as more kind of analysis is done, it's very likely we'll see that the Black Lives Matter movement played a critical role in Biden's election. And Citigroup recently came out with some really powerful research looking at basically the structural kind of racism in the U.S. economy has cost the economy, they said, $16 trillion over the last 20 years. So, I mean, that's a real kind of economic impact that we as investors should be really concerned about. On the flip side, they've said that if we can address that, analyzing 4 key areas of economic racial gaps that exist between Black and white Americans could close these gaps and add about $5 trillion to the U.S. GDP over the next 5 years, right? So there's a good driver for us as investors to be working on that issue and tackling that issue. So I think those kinds of studies that really put that into context for investors are really helpful and really important, and thankfully more and more prevalent on that issue, on climate, on biodiversity. Ian mentioned the new task force on nature-related financial disclosures, which we're also a part of, and we'll be looking both at dependencies on nature, but the impact on nature. So I think there's a lot of great things happening, but I think we need to all do more work also looking at the interconnected nature of all of these crises and these risks, right? We can't just solve climate and then think about biodiversity. We need to look at them at the same time, and they're closely related.
That's right. Coming back to the trade-off point that Jan made earlier, I think Jan, you wanted to comment on this issue.
Yeah, I think just 3 points about diversity and race, but also gender. I think the first point is decision making. So it's very clear from lots of academic studies that more diverse groups make better decisions, and that's essential in the investment management industry. So being able to attract the right talent into our investment teams and building collegial type decision making with diverse groups is something we're focused on. I think the second is investment opportunities. We've demonstrated now for over a decade that businesses with strong female leadership do outperform, not enormously, but they do outperform consistently. And we're now looking for data around race and ethnic minorities to see whether there's a fact pattern there. And the third sort of more broad point is license to operate. I think our industry is notorious, as is the rest of the financial services sector, for being dominated by white males who went to certain educational institutions. And if we don't change that rapidly, I think we will lose credibility. So getting more interns from ethnic minorities, making sure that we've got gender pay gap data going in the right direction, and just aiming for more diverse workforces, as well as giving money from the profits that we make to support diversity-based initiatives in wider society. That's essential if we're going to be in business 10, 20 years from now.
Thanks, Jan. We've got a little bit more time. I'd like to perhaps get closer to a theme that's quite close to investment, which is performance and returns. So we've talked about the impacts that investments can make, and we've talked about some of the metrics that we can track to assess that. When it comes to pure hardcore performance of the investments, that is the returns, what have we observed so far when it comes to impact investing? What has been the overall performance? Do they overperform? Are they on par with typical investments? Can I ask this question to Zoë, perhaps? I think you've done some research into this.
Yeah, we have. Our global research team look at this quite closely in the context of thinking about climate solutions particularly, but also the broader ESG agenda. And they found that in the first half of the year, the climate-related stocks outperformed the index by almost 8%, which is clearly significant. Now, that was from December, but even if you take the more intense COVID period globally from February onwards, the outperformance is still 3%. So there's something to be said by that selection approach. But when you take the ESG broader indication, the outperformance is around 5%. So there's this increasing groundswell of thinking that is incorporating ESG is just common sense, because it allows you to better, more accurately address risk and better, more accurately think about opportunities. And of course, there's a core to the way that investors are deploying capital and making capital allocation decisions. So that performance point is well entrenched.
And again, if I can ask perhaps for the practical, concrete experience of investors on the panel, maybe Jane, if you can tell us a bit more about how the funds have performed.
Sure. Look, I mean, I guess first point is we need to be sure what we're talking about, right? So, I mean, generally speaking, I completely agree with Zoe. You know, and the academic evidence would reinforce that. You know, there's growing evidence that a variety of different ESG factors can be and have been material to different companies over time. That's why we invest a huge amount of time and effort in our own proprietary ESG research. We score more than 12,000 companies. That's fully integrated into our different investment processes. We manage that. We measure that. We report on that. So across the board, you know, we think that sustainability factors can have an impact on investment outcomes, and that's why we manage them very closely. Now, if we go into the kind of sustainable plus range of our offering, where we have different funds, whether they're SRI funds, that have a label that tend to avoid the worst excluders, or the worst kind of enterprises in terms of how they score on different sustainability related topics. Or we also have, sustainability themed funds, whether they're around climate or water or, inclusive growth, as I mentioned, and then impact funds, whether it's around, something like our green bond fund. So in the Sustainable Plus range, some funds have significantly outperform, others on a relative sense may not outperform as much. We don't have a higher or a lower performance threshold kind of objective as a rule of thumb for the Sustainable Plus range. Generally speaking, we would expect financial performance to be, a target identified relative to the investable benchmark where there is one. And we wouldn't systematically say our Sustainable Plus range should have a higher or a lower performance threshold than the wider range of investment funds. So we don't structurally see it as something that's going to add or detract from performance. Now, Ian mentioned earlier about the range of impact funds, and you have other types of impact funds, which are giving up, intentionally giving up an element of outperformance or performance target in order to achieve a specific impact target. Now, I think from an investor perspective, you need to be clear about what you're looking for and what you're seeking to invest in. There are a number of, particularly I think in the kind of private market, high net worth individuals who are interested in that kind of very high impact area, and which then kind of, the next step along the chain is philanthropy, right? So that's an interesting area. You can create a lot of really significant impact there. That's less of a focus for us. We tend to focus on funds which also have financial goals on par with kind of the broader industry, and the financial goal that we would seek to achieve in our green bond fund would be similar to a credit fund, but we're focused on green bonds, and we have the additional kind of impact, measurability, and reporting. So as a rule of thumb, I think you need to be careful about what you're talking about and where you are on that investment spectrum. But for the vast majority of our sustainable and impact funds, there's definitely not an automatic haircut. And we also think that by generating these extra insights, it can lead us to create additional value for our clients.
Thanks, Jane. I think, Jan, you wanted to opine on this as well.
Yeah, so look, I think it's really important to look at both risk as well as return. Over the last 5 years, we've seen a number of core industries, the energy industry, the consumer goods industry, to some degree the transportation industry, decimated by technology, or more recently COVID. And so relative to those industries that don't tend to feature in many directional impact funds, those of us in the directional space, in other words, investing in environmental solutions and social improvement, have seen some phenomenal returns. And so we quoted some numbers. So those are typically the last 5 years. If you take a longer term perspective, and Impax has been investing for more than 20 years, if you sort of take a 15 to 20 year view, and you put aside manager skill, so you just ignore stock selection, and you just look at, say, baskets of directional stocks, so environmental markets type stocks, then you're typically seeing 1 to 1.5% annual performance with normalized for risk. So if you sort of strip out risk and just look at excess return risk neutral, you're getting 100 to 150 basis points. Now, a good fund manager should be able to, that's per annum, a good fund manager should be able to outperform that. And then with directional funds, of course, you're not just getting this long-term investment outperformance as society pivots towards the clean, more sustainable economy, but you're also getting these environmental impact metrics for free, if you like. So that's the benefit of directional investing. You can stick to your standard fiduciary duty of trying to stay in line with or beat the market, and you're also getting these environmental impact metrics.
Thanks, Jan. I have time just for one last question, which I'll ask to Catherine. If perhaps you can tell us a bit more about the task force which you have with HM Treasury and some of the themes you're working on, which you could give us a sense of the outlook for the industry in 2021.
Sure, thank you. Well, I've been working on a piece of work which is under the auspices of the British government's Treasury Asset Management Task Force, where we're looking specifically at how do we improve standards of stewardship, investor stewardship. So we're really focusing on not just publicly listed equities, but all asset classes, and this role that investment managers can play in having a really kind of purposeful dialogue with the management of companies, designed to both manage financial risk and return, but also drive the kind of changes that people want to see in the corporate community. We fundamentally believe that companies can play and will play a decisive role in managing many of the long-term threats and challenges we face as societies, whether it's inequality and racial injustice, poverty, climate change, biodiversity loss. You know, the companies in our world are shaping all of those challenges day in and day out in everything they do. And what we want to see is an investment industry that's really engaged in a purposeful conversation about with the boards of companies about how they're handling those issues and how they are, in addition to building successful, innovative companies that build prosperity and generate financial returns, they're also making a contribution to many of the resolution of many of the challenges I've just named, and also taking responsibility for limiting the negative impacts they have. So, you know, all companies do have an environmental footprint, and what we want to try and see is that you know, they're investing in the innovations that can limit that footprint and help us transition our world for, you know, low carbon prosperity. It's enormously challenging. Enormous kind of grit, determination, and creativity is needed in the corporate sector. And what we need is an investment community that's really behind the corporate sector in driving impactful growth, you know, wealth creation, positive, impactful growth creation. So that's really very much the philosophy behind the task force, and we're bringing out our report next week. It will have lots of quite technical, practical, you know, nuts and bolts recommendations for what needs to change in the pension sector, in the you know, wealth advisory sector, in the asset management sector, and in the regulatory community to try and bring about that kind of change. And I'm very hopeful that with everything we've been talking about, with this huge kind of popular demand for this style of investing, that with the type of changes and recommendations we're proposing, we can see very, very positive change. And to go back to Jane's point, I think that the election of President Biden as the president-elect coming in January, I think is only going to further supercharge many of the positive trends we've seen in the last few years. But he can't do it alone. None of us can do it alone. It's absolutely up to everyone with any kind of exposure to the investment sector, and particularly, you know, that the clients and individual investors that might be watching this, to kind of really get behind this movement and make a difference in, you know, in your small way, to contributing to this wonderful change that we're seeing in the investment industry.
Thanks very much, Catherine. We look forward to seeing the outcome next week. And you really give a sense of, I guess, what the audience could perceive through the discussion on the panel today, which is a very, very exciting, promising moment for impact investing. A huge challenge, but huge opportunity as well. And the sense that foundations have been led, and more hard work needed, but definitely a massive opportunity that needs to be seized. Sadly, this is all what we have time for today. So I'd like to thank the audience for tuning in. Thank you all our speakers for their insights and for sharing the views. Thank you also to our sponsor, HSBC Private Banking, for helping make today's discussion possible with their support. I would also like to say that the session will be available for viewing afterwards, so I would encourage you to return to the site to watch it again, or share it with peers and colleagues who may be interested. We will be hosting similar events in the coming weeks, including another one on December 1st on philanthropy in a changing world. You can sign up for dates from The Economist events, or log in to events.economist.com regularly to check for any news on those events. Thank you very much. Enjoy the rest of your day.